Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight are Jordan Toy from Legacy Family Wealth and Devin Shutte from the Robey Group. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents, and Jordan for joining us in studio. Shame, Devin, I know that shame, even if you wanted to, you can't join us in studio.
I know, I'm feeling very left out here.
Well, talking about being left out, the rand, wasn't left out of the kind of green that we saw, green trading that we saw today. At some point at 17 Rand 27, I see now that it's gone back to above 17 Rand 34, but still very, very strong compared to what we saw leading up to the US election and the result. Jordan, starting with you, I mean, what do you make of the strength that we are seeing in the currency, particularly looking at the fact that before this election result, everybody was saying, no, we're going to be in a stronger dollar, weaker rand kind of scenario?
Well, it's naturally been quite a big week. There's a lot going on. We've got the decision out of the Federal Reserve later, which I think is largely priced in, and I think if there's anything other than a 0.25% cut, it would be quite a surprise. Having said that, that maybe factors into the rand view as well, but there's a lot of factors that go into currencies. Like, for example, and I know it's not a direct link necessarily, but I've been looking quite a lot at the yield on US treasuries and specifically, some of the longer dated treasuries. And, there's been quite a lot of movement there, obviously linked to the election. There's been a lot of noise. I mean, we've seen markets move drastically yesterday from the dollar strengthening. Obviously, the rand strengthened, as you said, later today.
Yeah.
But there's a lot of movement going on, and I think a lot of short-term noise, but I think also it's got to be borne in mind that fundamentals, or at least in my view, fundamentals play out over the longer term.
Yeah.
But the short term, we've seen some strengthening out the rand, and what comes to mind immediately is that there is an expected 0.25% rate cut later.
Well, talking about the short-term noise that Jordan is talking about, Devin, are we just factoring this in as to, the market will be volatile and where really we can't be too optimistic on what the rand is doing at the moment, where we need to make space for maybe even further weakness at some point soon?
Yeah, look, it's possible. I mean, Zinat, you and I have chatted about the rand often, and I think we get it wrong more than we get it right. But what I will say is it's a relief to finally have that US election behind us. Jeepers. We came into this year knowing half the world was going to vote. The US was really the big one globally. Now we're kind of seeing some of the real-time impacts of that. So, massive rally in risk assets. Yesterday, dollar was strong, and now that looks like it's reversed quite a bit. And giving the rand some reprieve there. So it's nice. So, how this kind of settles, Zanati, I'm not entirely sure, but there's a lot of interesting things happening at the moment. Jordan mentioned the bond yields. Those spiked yesterday. But I think what's happening there is that the specter of inflation with the Trump presidency is starting to loom over markets, and markets are getting somewhat concerned. There is questions around how that will affect emerging markets and South Africa specifically. But kind of if I take a step back, I mean, I think we know President Trump is a negotiator. He'll always put the most extreme version first and then kind of moderate from there. And my sense is the market may be overreacting to future higher inflation. I think Trump at his core is a real estate guy. I think he likes lower rates. If you looked at how much pressure he put on the Federal Reserve in his first term, I don't see why it wouldn't be the same now. So I think he's going to be very cautious about really stoking that inflation fire and, forcing the Fed to maybe shorten their rate cutting cycle. So that's one scenario. I think it's likely, but we're still very, very early days. And let's see what the Fed says tonight.
Quite an interesting strategy there that he comes in hot and strong and then kind of pulls back a little. Maybe I should apply that to my life as well in my negotiations. Talking about spikes, SAPI spiked a lot today, more than 9%, Jordan. And actually looking at the numbers on a yearly basis, they didn't seem too great, although they did say that they exceeded their expectations. Is that what investors were holding on to? Because obviously when a company comes out with these softened numbers like this, kind of expected the share to tank, but actually went the opposite direction.
So certainly one of the bigger movers today. And Sappi is a company that we don't cover exceptionally closely, but having looked at the results today, what appears to be the case is the last quarter was quite a strong quarter. So potentially a case that the market is aware that the yearly outlook is not great, and as you already mentioned, those yearly figures are not spectacular, but a decent quarter that they've just come out with. I think across the board, when I was looking at the numbers earlier, fairly positive. So maybe that's just the market looking at it's a bit of a positive surprise considering there's a bit of a gloomy outlook that's already priced in.
And actually, there was a stock watch where I spoke about Sappi, and I can't remember who actually said it. And they were saying that there seems to be more movement and more buying when it comes to Sappi versus Mondi, and where Mondi has basically become the dark horse of that paper sector. Devin, would this be evidence of that, the kind of moves that we saw on Sappi today?
Sure. I don't know. I mean, I think those results weren't great, but to your point, I think they were better than the market was expecting. I think what worries me is that debt is still very high. Earnings were under pressure there, margins under pressure, and they're still calling it a tough macro environment out there. So they're doing what they can in terms of efficiencies, which is great. But would I put them in the same boat as Mondi? Probably not. I think Mondi's got far higher quality of earnings. Balance sheet looks a lot stronger. But both of them are cyclical businesses. These are raw materials. The underlying timber prices that dictate a lot of what happens there, and input costs from electricity and the like. So very, very cyclical businesses, and I think Sappi's results today just reflecting that.
Well, another company that came out with numbers, and I actually see that Truworths, TFG, and Mr. Price are all down. It was Truworths with their business update, Jordan. Did Truworths just bring everybody down at this point?
I actually had a quick look at that before coming into the studio as well. And look, I haven't looked at Mr. Price and some of the other retailers specifically, but clearly the retailer's not having a great day today. But Truworths specifically, having a look at the numbers earlier, not massively spectacular results. Retail sales relatively flat, even more so in the African operations, so barely any growth there. A little bit of a bright spot, or I think they described it as resilient growth, coming out of the Office UK franchise, which I still find a slightly confusing name considering what they sell. Having said that, I think nothing great there. They even described it as a continuing tough macroeconomic environment in South Africa. And, I think we see, there's a lot of optimism around the government of national unity, but I think we're seeing it in these companies as well. It's not necessarily translating to earnings just yet, or it's not materializing, at least for some of these companies to date.
Well, that's interesting because, you talk about the positive sentiment and the confidence that is around here, and there was a time where everybody was buying the retailers. What's confusing me, Devin, is the fact that these numbers are backward-looking, but we know what is to come, but investors reacted quite strongly to the downside today.
Yeah, look, it's still tough out there, right? There's hope that things get better and that we ignite growth and that our rates start to fall precipitously. But I think the reality for most people's experiences is that it is still somewhat tough out of there. And I think while the valuations of these retailers have unwound quite a bit and are starting to look incredibly attractive, maybe not the catalyst that all investors are looking for yet. My argument would be that a lot of these retailers, Truworths, Mr. Price, you mentioned, are in decent shape. They've weathered terrible trading conditions for many, many years. So I don't think it's going to take much economic growth to really see a significant uplift in those earnings and re-ratings there. So Truworths today, pretty lackluster. As Jordan said, the UK looked okay. Online sales are growing well off a low base, which is kind of across the board with the other retailers. But I think still a lot remains to be seen.
Yeah, all right. Let's go into tech because there's a question here. For the last 15 years or so, tech has been the best performing industry, mostly Magnificent Seven. I believe these companies are in such good competitive positions. They make so much money. They're almost untouchable in their respective products and services. I have a portfolio of, in my opinion, high-quality compounding machines. Google, Apple, Microsoft, Visa, Meta, MasterCard. That's all that my portfolio consists of at the moment. Let's actually start off with that, because there is a second question. All of that, just tech in your portfolio. I understand that they performed very well, but is that not risky, Jordan?
I think certainly it is risky. I'm sure Devin will agree with me in a moment, but definitely an aggressive portfolio. Certainly it's done well over the last quite a few years. I'm sure of that.
Yeah.
We often talk about, diversification gets talked about a lot. Mm-hmm. It's fine on the way up. It's not that these things move in a straight line. So yes, they are good companies. I myself have a number of tech companies in my portfolio. Mm-hmm. I think they are great companies. Would I own a portfolio exclusively exposed to tech? Maybe not, just because you want that bit of a blend in the portfolio. Having said that, market leaders, very established positions, arguably some of them are borderline monopolies. And they're able to spend, AI has obviously been a theme for quite a while. They have the bank balances to actually get heavily involved and build these data centers, the likes of Amazon, Meta, Alphabet, where a lot of others can't. So, and they're all telling us that as well, that they're spending all these massive amounts of capex because it needs to be done, that they can get sort of ahead of the curve there. So there's a strong argument to always have tech in the portfolio, but again, very, very aggressive positioning.
Things are good now, but
well, you've got to be along for the long-term ride. So potentially, there's maybe a pullback in future, but if your time horizon's long enough, potentially those are a good sector to be in and some strong companies.
Very strong nerves that the viewer has.
Yes.
Devin, the second question is the likelihood that tech outperforms for the next 15 years a high probability or not? I guess that's the $1 million or $1 billion question, isn't it?
That's exactly right, the $1 billion question. Well done to the viewer for being so concentrated in tech. It has been the place to be for the last 15 years. Will the next 15 years be the same? My view is probably unlikely, and I think the reason for that comes to interest rates, and that we've been through a period of abnormally low interest rates across the globe, but particularly in the US after the global financial crisis. We've also had a lot of monetary stimulus coming into that, and so that's made these high-flying tech companies all that more attractive. They've had massive momentum and index buying behind them. They are great companies. We use them all on a daily basis. They're strongly cash generative. So, I dismiss the kind of parallels with the 2000 .com crash. But the reality is 5 shares or 7 shares or whatever the case is a full portfolio. It isn't. For your personal portfolio, it can be great. And, when it works wonderfully like it has. But I think you've got to be asking the question, which the viewer is, what does it look like going forward? And my sense is that these companies will still have a very important part to play. But I'm not sure the easy money that you've had or the significant gains you've had will be there. You look at the highest of flyers at the moment, NVIDIA. Yeah. They really dominated that GPU market, rightfully so. They're growing sales significantly. But my sense is that whole AI market eventually has to mature and move to a lower cost model to make it really globally scalable. And, there go your margins and, what does the price of NVIDIA have? So I'm not predicting all fall down. I just think you probably need to reduce some exposure and concentration to the sector. I wouldn't say entirely. And it's something we've been doing in our portfolios.
All right. There's a question, how does Jubilee Metals versus Pan-African Resources compare as an investment destination? I know that none of you look at Jubilee Metals because it is too small for you. I think it's diversified. But Devin, starting off with you, is it on your radar on some level at all or not?
Sure. Short answer, no. For Jubilee, can somewhat, and I think the gold miners definitely. So maybe we can chat around those drivers there. I think we're all aware of how well the yellow metal's been doing, and these gold miners, particularly the lower cost producers, have just been massive beneficiaries of it. You know, I mean, a gold mine in its simplest form has got fixed costs. It digs the stuff out the ground, and when the price goes up, you know, those margins just explode. And you know, we've really been seeing that. So you know, Pan's had a terrific year so far. Up, you know, doubled your money already, which is good, and trading near pretty nice highs. Yeah, they got fairly nice resources spread all over the show. But I think maybe of more interest to us is Anglo Gold. That was out with I think it was a trading statement or results today.
Results.
Yeah, you could just see those earnings expand, massive cash flow generation. Aussie and Brazil really doing well for areas there. But you know, these counters are feast and famine, and I think you've really got to use them as trading stocks. And you know, probably when they're looking so good at the moment is the time to be taking some money off the table. But it's been a fantastic place to be. You know, gold's been a great kind of hedge, but actually also a really nice alpha generator for portfolios. And yeah, the gold miners themselves have just been that on steroids.
I also thought it was a trading update, and then I realized that they are listed in the US as well. So they're going to be coming out with quarterly results there. Jordan, your take on the gold counters, and particularly Anglo Gold, and I'm actually seeing that it was up more than 5% today.
Yeah, and I like that Devin touched on the cost conversation in gold mining and the cyclical nature of gold, but also commodities more generally. So, you know, it's a situation of make hay while the sun shines, and I think we as South Africans are quite familiar with, you know, when our ports aren't working, that we battle to sort of benefit from when the commodity prices are really high. And just on that cost front, I was looking at the results, the same results obviously Devin was, and as he mentioned, cash flow up massively. But just looking at the average cost price of the gold that they're pulling out of the ground versus the price that they're selling for that gold, and how that has changed over the last year. I mean, you can just see, you know, great management coming through in terms of managing those costs. So I think their average cost price per ounce went from, call it $1,000 odd to less than a $100 increase, whereas on the selling price, the same ounce of gold they're selling for $600 more. So, you know, good cost containment coming in, and they reaping the rewards of that. So a pleasing result out of Anglo Gold Ashanti, and I think I was looking earlier, and the broader gold sector, all of those shares are also doing well. Naturally, gold's at a high. So
well, I mean, just on Trump's victory, Devin, because there was also a narrative of, because everybody was trying to figure out, you know, what's going to benefit, which asset class is going to benefit, which ones not so much. And gold was one of them. I do note that you say that, you know, maybe these gold miners, you take them as, you know, for trading opportunities where you just be trading them. But in an environment where there's all this perceived, maybe possible escalation in geopolitical tensions that could boost the price of gold, would you maybe not take a longer term investment approach to gold, or would you still be sticking to just trading it for short term?
Yeah, I'd probably still advocate trading the miners. I mean, the gold itself has a potentially interesting place in portfolios, exactly as you said, you know, a hedge against geopolitical risk, also a hedge against kind of ballooning fiscal deficits, hedge against inflation. And so, yeah, I definitely think there's an argument for that. I think potentially Bitcoin as well has been filling that digital gold role, and you saw that also spike up. I know Trump was pro crypto, but I think it could be filling both of those mandates there. So yeah, I mean, I think investors do need to be thinking about these type of things, and I think increasingly with the central bank buying away from treasuries into gold, I think that trend is likely to remain entrenched. So yeah, definitely one to look at, in my opinion. So
yeah, Jordan, I mean, how would your approach be to gold or the gold miners, short-term trading, or would you be taking a longer-term view maybe on some of the gold miners?
I think firstly you've got to have nerves of steel to be a long-term nerves of gold to be a long-term investor or a trader in any resources stock, just because of the cyclical nature. And I think a lot of people have lost their shirts, as well as I'm sure made fortunes in the space.
Yeah.
And Devin correctly touched on the point, I was quite keen to mention it, that central bank buying has picked up quite a bit over the last couple of years. Does that sustain itself? That's not the sole source of demand for gold, but it's become a larger slice of the pie.
Yeah.
And that's obviously a factor in the price. So does that continue at its current run rate? Hard to say, but I think either take an exceptionally long-term view, or you need to be trading it on the shorter term basis, but have nerves of gold, as you said.
All right. Well, let's go into cars, second-hand cars. The viewer's asking, what is fair value for We Buy Cars? Devin, do you have any insight for us there?
Yeah, I mean, we've got some models we run. I'll say that it is lower than the current trading price. You know, the share's been on a massive tear since it IPO'd. It's been terrific to be involved there, and it is a nice business. So I think what I'm saying is probably just run a little bit ahead of itself. But I think, you know, the tech that We Buy Cars and kind of the disruption of that, you know, typical trading model with a dealership that they've brought has just been terrific. And they're not stopping. They're sticking to their knitting. They're continuing to roll out premises and pods, and they're just incredibly successful at it. I mean, they feel huge, but I think their market share is still only around 10-15%, and I only see that growing. So yeah, it's definitely been a South African success story. Great new addition to look at, but I think might be just a little bit rich at these levels.
It's quite interesting because I don't know if, you know, if there was a lot of appetite for it when it first listed, but now you're just seeing the rise and the rise and the rise, and now it's basically, yeah, it's at record highs. Yeah, is this one on your radar on any level, Jordan?
Not one that we follow exceptionally closely, but having said that, and you talk about the question of fair value, and I think Devin mentioned it as well, you know, how long is a piece of string? Everyone in the industry probably runs some format of a model or another to try and estimate fair value, but there's a lot that goes into that and a lot of assumptions and long run growth rates, and you know, my fair value estimate probably differs from Devin's and probably everybody else in the market. So there's a range, and you know, is it massively? I think you're more looking at how far away from your estimate of fair value it is. But as you mentioned earlier, a nice South African success story, I think. I think in my view, any new sort of share to be traded, whether it's a new listing or a spin-off from an existing company, is something to be welcomed on the JSE, especially considering, you know, the trend of delistings we've seen over the recent past.
All right. Well, gents, let us get to your stock picks for today. Devin, what are you picking?
So Nati, one we chatted about before, and I'm going to use it again because of what it did last night, the S&P 600 small cap ETF, code SPSM. And here, very similar to the Russell 2000, they were both up 5-6% last night with that Trump victory. The differentiator with this index is that it requires its constituents to be profitable, whereas a lot of the Russell 2000 constituents are not. And small cap stocks like lower rates. They like animal growth, throwing a bit of animal spirits after a Trump win. And yeah, it really was off to the races there. But we think, you know, speaking earlier about reducing concentration to mega cap tech, we think this is one way to do it while still being exposed to the US economy, highly rate sensitive, and we think it's one to look for in portfolios.
All right. What are you looking at today, Jordan?
I'm going to talk about Palantir Technologies. So quite an interesting company. Very much in the AI space. So obviously it's run very hard. I think it's up 200% over this year. But they're growing earnings nicely. They came out with earnings on Tuesday, I believe it was. Quarterly revenue was up 30%. So they're doing a lot of very interesting stuff. And for me, the reason I like it is it's one of these sort of more tangible cases of an AI company producing results. So we've already talked about the Alphabets, the Metas, you know, they're all spending all this money. And are we seeing the earnings come through that's clearly a result of AI? I think this is a company where that's clearly the case. And I mean, I have to share a quote from the CEO who said, "The world is in the midst of a US-driven AI revolution that is reshaping industries and economies, and we are at the center of it." Wow. Obviously quite bold, but you know, they've got a lot of US defense contracts, government contracts, also the private sector, very US focused. So I think like 70% of their revenue is coming out of the US. And again, in a space that's run very hard. Everything AI has run very hard. But for the long term, I like the company. I think they're doing a lot of very interesting things. And you know, when the US defense and intelligence sector starts really implementing something like that, I think you sit up and take notice.
All right. Well, thank you so much for your time, gents, and your analysis. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Jordan Toy from Legacy Family Wealth and Devin Shutte from the Robey Group. Up next, The Close. Stay tuned.